Hi, this is Ken here from Smart Forex Education. Today we're going to focus on how to manage a trading position. Now we all know that anyone can enter a trade, but in essence the end result of the position is based on how you manage it. At Smart Forex Education we look at two primary setups for exiting positions. What we can look at, I'm just going to show you here. Number one, we look at having a trailing stop option. And then number two, we look at targets. Okay, so there's two options you can use. You can use the first trailing stop option or targets. So if we focus on the first one, trailing stop, if you've entered a trade based on a high probability setup and you feel that there's a lot of room, this market can really move in your favor, then one thing that we like to look at, we don't want to cut our trades. What we like to look at, we look at how we can actually maximize the potential of the trading position. So our ultimate aim is to continue to stay in the trade until the market tells us otherwise. So if we look at here the pound dollar, this is on the 30-minute chart. I'm just going to actually identify a potential move. We actually enter the trade on a nice entry setup, which we'll go into on the next module. But the entry setup on this trade, we enters about 15502 on the pound dollar to the upside. So what we did is we enter the trade to the upside. So the key is, where do we want to sell out? So we use a trailing stop option. Now the trailing stop option, we went to lines, Fibonacci extension, and then freehand. So with extensions, we took the low point to a significant short-term high for a bounce. And then we had our extension levels in at 61.8, 78.6, 100, 127.2, 138, 161, 261, and 423. So, once they were intact, what we did with this system was when the price tested, I'm just going to show you here, show percents. Okay, we'll just show percents. Once the price tested our first target that we had in place, what we then did is, our stop was below the lows. Okay, what we then did is we trailed our stop. Okay, so we had a stop below the lows of the day, and when the price tested the first high, test the first target, which was our 61.8% level, we trailed the stop to break even. So what actually meant that we felt that there was a lot of room, a lot of potential move to the upside. So what we didn't want to do, we didn't want to scale out of the positions as it hit the next target. We basically trailed our stop to break even from the entry price once the price hit the 61.8%. And then what happened, once the price then hit to the 78.6% level, we then trailed our stop, okay? We then trailed our stop just below the short-term low of where the price tested, okay? So when it tested 61.8%, we trailed our stop just below the previous bar. And then what then happened, as the market moved up to the 100%, we trailed our stop to the 78.6% below, slightly below, 2 or 3 ticks. And then when it tested the 127%, we tried our stop to the 100%. Then it tested up to the 138. We then tried our stop to the 127. Then went up to the 161. We tried our stop to the 138. So in this scenario, as the market continued to move in our favour, we trialed our stop accordingly. Now, one thing here which works out pretty well. If it's a strong move to the upside, or whatever direction you took the trade, in this example here, we went long. So if it's a strong move to the upside and there isn't any retracement, the number one how to manage position works out very, very well. Because if a retracement occurs, we'll be stopped out. But number two, if you use the targets and you felt that this market may have some room, but it may not move on a strong move to the upside, i.e. it may not be driven by economic news, then what you can use the number two setup for exits. You can use a target whereby if you had entered, for example, you were small account size and you had 5 micro lots or 5 mini lots, what you can then do, if you enter the trade to the upside, you can then look at putting limit orders. So you can put limit orders at a selling out position, the first lot at 61.8, the second lot at 78.6, third lot at 100, and then fourth lot 127, fifth lot at 138. For example, if you had 5 mini lots or 5 micro lots or 5 large lots. So what's happening is as the market's moving in your favour, you're actually scaling out of the position. Okay. So number two setup. As the market moves in your direction, you are scaling out of the position. Okay, so there's two ways. So what you need to do really, on the basis of making a decision on what you're going to do, you need to be, obviously it's important to have experience, but you need to have an intuitive feel to what's currently going on in the market. If it's been driven by some economic news that's come out and it's very, very strong, let's say, for example, after you enter the trade, then you might look at basically just riding the position and trading your stop as it moves in your favour. If you feel on the otherwise, alternatively, that you're quite confident of the move, but it might not move straight up, like a strong move to the upside. So what you can then look at doing is having your lots, or let's say limit orders, located at the Fibonacci extensions. Great. Hope this helps.